we have a market today which feels superficially like 2000. And I think it's going to play out initially like 2000. And then, unfortunately, is going to phase, as he suggests, into the 70s, where the deflationary effects on the economy and the stock market will result in a world rather like the 70s, where all assets are simply much lower priced than they are today. A word on inflation, too. I completely agree with Ray on short-term problems, which I would summarize as monetary and general Federal Reserve overstimulus for 30, 35 years, the war and COVID, all of those three influences guaranteeing that we have a relatively intractable problem in the short to intermediate term. But what worries me is the longer term arguments for inflation, which is one, we are running out of people. In China, where the 500 million extra farmers precipitated globalization, they have now had diminishing cohorts of 20-year-olds for 20 years. And they are guaranteed, since they're alive now, we know the baby cohorts are dropping like a stone. They are simply going to have a shortage of labor, as is the developed world together. That is not a trivial block, the developed world plus China. All of them will be squeezed for labor. After the bubonic plague, they had a 100-year honeymoon period in which wages went up so much it wasn't reached for another several hundred years in the Industrial Revolution. And we are entering a period where labor is simply scarce, which feels to me inflationary. And at the same time, we have a scarcity beginning in resources. And we keep an original, unusual index, a GMO. It's 36 equal weighted, important, the most important commodities. So it's not dominated by oil. And it showed a declining pattern for 102 years, from 1900 to 2002. And yes, it was interrupted by World War I and World War II and OPEC. Why wouldn't it be? But it wanted to go down. It went down 70%. It took the index down to 30. Today, 122 years later, the index is down 10%. It has gone to 90. The average important commodity has just spent the last 20 years going from 30 to 90. It has tripled. The reason is, of course, the growth of China, but I believe, fairly passionately looking at the data, that it also represents the intrinsic scarcity, the war between deeper wells, worse iron ore, etc. The best go first. The struggle is always between technology, which for 100 years got ahead of scarcity. It was 2 paces down for deeper and 3.5 paces up for technology. And now we've reached a phase where we've gone through that stuff. And now we have 2 paces up for technology and 3 paces down for scarcity. The data is screaming at us now for 20 years that we're beginning to run out. It doesn't, and a war, of course, and COVID, we're so fragile. All you have to do is cough now, and it ricochets around the world in price spikes and shortages and bottlenecks. And that is the world we better get used to living in. We're going to have a world of increasing number of bottlenecks and shortages. And the same applies to food. The UN Food Index is higher today than any time in its history of the last 50 years, since it started, okay? So you have price pressure on raw materials, metals, food. You have price pressure long-term on labor. This surely feels like a new era in which inflation will be part of the background music, just like it was in the 20th century, and perhaps more so. The risks of a debt bubble breaking and the risks of an equity bubble breaking have simply not been understood by our Federal Reserve since Paul Volcker. They are incredibly naive. They haven't even got a clue. They're not even interested in the idea. The idea, Bernanke's saying, oh, the US housing market's has never declined. It merely reflects a strong US economy. Alan Greenspan encouraging, et cetera, right through until today. They don't realize that they're playing with such fire. My second point, high levels of debt are just far too often seriously dangerous and should be, in general, discouraged actively. That should be one of the responsibilities of top management, including the Fed, et cetera. And let me just give you an example. Why do you like low rates? Because it encourages debt. Why do you like more debt? Because it encourages growth. That's the argument. So let me give you the ultimate statistical test of that. We started in 1985, and we have been modestly increasing the debt to GDP ratio, all debt together, just drifting slightly up due to technology. And then the technology, I mean the introduction of more and more sophisticated financial instruments, but not rising dramatically. And then in 85, it kills to a 45-degree angle and shoots across any page and goes from about 1.1 times GDP to well over 3. So in that little window of 35 years, we triple the debt to GDP ratio. It's a big chunk of time. It's the biggest, most important economy on the planet, a pretty good test. So what happens to growth? It inflects downwards. And from 85, we grow more slowly. Grant you, there are many other factors at work. It's a complicated picture. But there is little room in that equation for the idea that more debt creates more growth. It is not proven in the data. It is held to be the case. It is an assumption like most of modern economics, but it is not proven by the data. I would suggest that there is no evidence at all that increased levels of macro debt to GDP have anything to do with growth. They have everything to do with higher risk, though, from time to time. Ray made me think that when we're selling our resource portfolio, we have a wonderful exhibit that looks at the correlation between all the major sectors, utilities, consumption, and so on, consumer goods. And there's only one where, as the time period lengthens, the correlation drops, and that is resources. And resources drops to such good effect that based on the last 80 years of data, every rolling 10-year period, that the 10-year correlation is negative. So if you believe in inflation, you know that resources do very well. You also know that in the long run, it's strongly negative. It's negatively correlated, modestly, with the rest of the portfolio. As we're seeing today, when they do well, it puts a burden on the rest of the economy and they do bad. So there is a very strong case here for a resource portfolio. On resources, just a point that the last time we had a super bubble in commodities, there were very large new mines waiting to come online. What has happened since the 2011 crunch, when China slowed down in its heavy industrializing, and the growth rate for iron ore and coal dropped from double digit to zero, dead flat for 3 years in a row, breaking the back of the resource industry. They have not done any capex. It takes 5 to 15 years to bring on a mine. They have not been doing this. There are no great reserves of lithium, cobalt, copper, nickel, even iron ore to come online this time, and everybody knows it. If you look at the need for these, particularly green metals, greening metals, it doesn't compute. There are no backup resources. And that applies right across the length and breadth of resources. They have not been capexing, even in oil and gas, for the last 10 years, to a remarkable degree.